Hello, this is the pre-show for the new stimulus package explanation. My name is Aardvark Arnie, and I've been reading these laws and really looking forward to having Brandon Ketron and Alan Gassman explain them. So they'll be starting in about a minute, but thank you all for being here. I see a lot of familiar faces, and ooh, put your clothes back on, turn off your camera. Don't forget that this is a two-way conference. During the conference, please keep your candy wrappers quiet, and please don't get popcorn all over the floor. Your significant other really doesn't like it when you do that. Take a power nap today so you don't pass out before midnight like I will, and I hope that you'll have a great time and that this presentation does not cause your head to spin. Okay, so hold on. We're just getting all the contracts signed to make sure that everyone is lined up for this presentation. Hi. Hello, this is Alan Gassman. Happy New Year, or almost. I'm here with Brandon Ketron, who has made my year a very happy one because he knows so much about PPP, Eidl, and the new stimulus package. So we wanted to share a lot of this knowledge and a few tips today. We are going to get this done in 30 minutes to 35 minutes. We know your time is valuable. Please do share this webinar. We'll be giving you a link afterwards. You'll get an email from our producer, Matt, and then please share this with as many people as you like to try to get the word out. The SBA has been given 10 days after passage of this bill to come out with complete guidelines, and I'm relatively sure that that's not going to happen. I'm also sure that when we do finally get guidelines, they're not going to be what we thought they would be. They'll be a little bit different. This law is 5,500 pages, double spaced, and most of it reads like this. For purposes of section B4 of XYZ, the word should shall become may. So then the law clerks have to go and find that statute and change that word. It really takes a long time to understand these laws, and quite frankly, the congressmen don't understand them. President Trump doesn't understand them, and the people who drafted them had to work all night. So they call this the legislation of sausage. So no matter what we tell you today, it may change. We may misunderstand it, or the SBA may misunderstand it. There'll definitely be a Technical Corrections Act, and welcome to America and the way democracy works. So page 4 of this PowerPoint, an extra $3 billion was added to the Provider Relief Fund for healthcare providers. That's mostly physicians and medical businesses. It is unknown how they're going to decide who gets what of that $3 billion, but that's a relatively small amount. It's less than 10% of what has already been given to medical offices and medical businesses. Number 2, doctors in 2021 will make an extra 3.75% on Medicare work. Bless them, they deserve it. They deserve more than that. Number 3, you have the continuation of unemployment. The federal unemployment benefit will be $300 a week through March 14, or a maximum of 24 weeks, plus the state unemployment. It's not the $600 a week that they had, but it's better than nothing for sure. As everyone's aware, if you make less than $75,000 a year and you're single, or less than $150,000 a year filing joint, you're going to get a check for $600 a person, including for dependent children. This is based on your 2019 tax return. You don't have to do anything. If you got this payment before, you're going to get it again, and many people have already received it. You don't have to pay this back. You don't have to reconcile this. You don't have to worry about what you got before. This is all just money you get. and hopefully you hold it for something very important, or you spend it for something very important, like gifts for your favorite lawyers. Number 5, again, no repayment requirement on these stimulus payments. Number 6, you can defer payment of your payroll taxes, which is a pretty big number for a lot of businesses, through January 1, 2022. So if you have not been deferring your payroll taxes and you're an employer, you may consider doing so, especially if you want to show that you're concerned financially about the situation of your business so that you can qualify for a new second bite PPP loan, which we're going to talk about in a minute. Key tax takeaways: teachers can now use their $250 annual expense allowance, which is deductible from their return, to buy both school supplies and PPE items. I sure wish they had expanded this allowance, but they didn't. Number 2, you could ask your CPA if you should make a 163J election if you are not able to write off all of your business interest because of the limitation rules. There's a little bit of leniency there if you have residential rental property. Number 3, you can stay at home if you have to and get reimbursed by the government, even if you're the owner of a C corporation or an S corporation, and you should know about the FFCRA credits. We'll mention them a little bit. Number 4, you're sitting at home with your loved one, you're sick and tired of looking at him or her, get them some plastic surgery. Your medical expenses exceeding 7.5% of adjusted gross income are going to be tax deductible. This was going to go up to 10%. So you take that $600 check or whatever check you're going to get and consider that plastic surgery and maybe even some liposuction for that significant other of yours. Maybe you could bring that up during New Year's dinner tonight or New Year's Eve dinner tonight. Number 5, speaking of dinner tonight, if you buy it at a restaurant, even if it's delivered to your home, and you have that dinner with a key business contact, then you get 100% write-off beginning next year, not this year. So go ahead, New Year's Day, do a Skype call with your most important referral source or one of your good customers, send them food from a restaurant, you get food from a restaurant, 100% write-off. Thank you very much. Number 6, next year as well as this year, you can deduct $300 a year gifting to charity if you don't itemize. And next year, it'll be $600 for a married couple. This year, according to the IRS, you can't deduct more than $300 for a married couple unless you itemize. Number 7, charity donations used to be limited to 50 or 60% of adjusted gross income as a deduction. Now you can go up to 100%. So Brandon, I'm going to hand it over to you now to talk about the changes to the PPP program. As everyone knows, the PPP program was a program that came out with the CARES Act in March and allowed small businesses to borrow approximately 20.833% of what their payroll expenses were in the prior year. So if you had $100,000 of payroll expenses, you could borrow $20,833. And then if you would spend that money mostly on payroll expenses, but on certain other things as well, over the following 8 to 24 weeks, you don't have to pay the loan back. And that's what happened for a great many businesses who are still in existence because of this program. Brandon, what have they changed as far as the original program is concerned?
Yeah, so a couple of key changes. The first one here, number 1, there's some additional eligible expenses. They're going to be non-payroll cost. But basically, if you spent money on worker protection equipment, if you spent money on your business to move towards a cloud software, cloud computing, improving the business to make it safer, all that's going to be includable as a forgivable expense, as well as any property damage that you might have received as a result of any type of riot. That can be also a forgivable expense to the extent that you weren't reimbursed for those. We have some slides later that go through that in some more detail and further define those additional expenses. Number two, you can select the end of your covered period at any time between 8 and 24 weeks after the receipt of the loan. The benefit here is that previously we had to spend all of the loan money in order to end the covered period, but now you don't even have to spend it. If you want to end it after 10 weeks, you can elect to do so, and then you don't have to worry about retaining your head count any longer. So some flexibility provided there as a result of this act, and allows us to end that covered period and go ahead and submit the application for forgiveness at any time. There's a simplified loan process if you have less than $150,000 of loans amounts. We don't know a whole lot about this yet. It's supposed to be a simple one-page application, probably going to look pretty similar to the current application out there for loans less than $50,000. That's the 3508S form that the SBA has released. We'll see what they do with this directive in the next couple of days. There are some additional payroll costs that you can include. Group life, group disability, group vision, and group dental insurance are now considered to be payroll cost. So you can add those in towards your loan forgiveness. You can also now add those in towards your application and get a larger loan amount as a result of payment of those expenses. And that also works here with number 5. If you have an original loan amount that's still outstanding and not yet forgiven, and any of the changes in the rules, either by the SBA through FAQs, interim final rules, any changes in this new act, you can amend your original application and get a larger loan amount. So one situation here, if you have large payments for these group policies, you might consider amending that initial application and requesting an additional loan amount. There's a $100,000 salary and wage limitation that applies. The act says it's pretty clear that applies on an annualized basis. So if you have a covered period of, say, 20 weeks, you would take 20 divided by 52 multiplied by 100,000, and that's the salary and wage limitation that would apply for the length of that covered period. If it's 10 weeks, 10 divided by 52 multiplied by 100,000 is the way that's going to work. Eidl advances, that's the $1,000 per employee, maximum of $10,000 advance you're able to get on an Eidl loan if you qualified. If you receive that, originally it was to reduce your PPP loan forgiveness. So in a way, it almost had to be repaid. Well, now Congress has said that's no longer the case. We're not reducing loan forgiveness by this advance. It's going to be non-taxable, not required to be repaid. If you've already submitted your application here, including and reduced your PPP loan forgiveness by the advance, you can probably amend that. The SBA is supposed to provide us with some procedures to how that's going to work. Number 8, if you're not in operation prior to February 15th, you're not going to be eligible to get a PPP loan. There's some language in there for new entities, but new entities still have to be in operation prior to February 15th, 2020 in order to qualify. All the existing exceptions to the headcount reduction rules, the salary and wage reduction rules, the safe harbor related to closure and not having full staff due to that closure, all those still apply for both the first and second round, but the SBA has the ability to modify the dates of the safe harbors. So we'll have to wait and see what comes out as a result of that, and we will update you as that becomes available. The act makes it clear Schedule F farmers can get a PPP loan. That's all based upon your 2019 Schedule F income for farmers. That works the same way it does for Schedule C, except it's line 34 of the Schedule F instead of line 31 for the Schedule C. 20.833% of that amount, maximum of $100,000. That's the PPP loan for the farmers. 501c6 entities are now eligible to receive a PPP loan, assuming that they meet all the other requirements, including the necessity requirement. We have some of those listed here that might qualify. Borrowers in bankruptcy can now apply for PPP loans with court approval. And number 14 is going to be a really important one here. We can get the employee tax retention credit if we also have a PPP loan. Originally, it was one or the other. So now we can get a credit in 2020 up to $5,000 per employee for wages paid if we meet certain requirements, and that's a credit against your payroll taxes. And then you can also receive a PPP loan to pay wages. You can't double dip for both, and we'll go through how that works, but it is going to be a nice benefit here. Retroactively, we can claim this credit, and then going into 2021, it gets even better. The credit increases from 50% of wages up to 70% of wages, and we'll go through those rules here shortly.
And be very careful, do not file a PPP loan forgiveness application until you clearly know whether that application could hurt your ability to get the employee tax retention credit. Because if you're getting forgiveness based upon certain wages that would have otherwise qualified for the credit, then you're not going to get the credit. So this is going to be a complicated situation that's going to definitely need to involve good CPA participation and a lot of careful spreadsheeting for those who may qualify for this credit. There's some very good articles on the Forbes blog by Tony Nitti, also known as the Tax Geek, that have just come out in the last few days. You can read them carefully if you like a really good mental exercise, because it's complicated stuff. Talk to your CPA. If you're a CPA, talk to another CPA and make sure you understand this before you file a PPP application for an S corporation, a partnership, or a C corporation that could cause loss of this credit. Go ahead, Brandon.
Yeah, good point, Alan. And the way that works is you can't double dip the wages. So if you take the forgiveness on the wages on PPP or pay the wages with PPP funds, they're not eligible for the credit. So you really have to elect and look at which one we want our wages allocated to. So maybe using some of those new additional costs that are as a result of the new act, and maybe spending a little bit more on non-payroll cost to leave the actual payroll for this employee tax retention credit is a good strategy. So definitely something that you want to look at and run some numbers on. Okay, slide 8 here, second draw PPP loans. You're now eligible to get a second round, but you have to meet a revenue or gross receipts test prior to being eligible. You have to have a 25% or more drop in your gross receipts, comparing a calendar quarter in 2020 to the same quarter in 2019. So again, we have to look at Q1 of 2020 compared to Q1 of 2019. Q2 compared to Q2, 3 compared to 3, and 4 compared to 4. We can't say, oh, fourth quarter was really high in 2020 and my first quarter in 2019 was really low. Let's compare those two together. That's not the way it's going to work. You have to go quarter to quarter. If you meet that test and you also have the loan that is necessary to support the ongoing operations of your business, you still have to meet that certification as well. So if you have a lot of cash in the bank, even though your revenues are down, and you could use that cash to survive through the rest of the crisis, then you're probably not eligible to get the PPP loan. So make sure you're looking at necessity and analyzing that as well. If you are a restaurant, a hotel, or a motel, you have NAICS code of 72, then you can qualify for 3.5 times your monthly payroll costs instead of 2.5 times. So a nice benefit for those types of businesses. Same rules still apply for most other businesses. It's 2.5 times your average monthly payroll cost for a 12-month period. The benefit here is we get to elect our 12-month period that we use. So it can be the 2019 calendar year or any 12-month fiscal year period before we apply for the loan. So if we're applying in February of 2021, we could use January 20 back to January of 19. We could use October of 2020 back to October of 2019. 12-month period at our election. So look at that. What maximizes my loan? When did I have the highest average cost? And that's the period you're going to want to use. We have until March 31st to apply. And then again, make sure we're understanding this interaction with the employee tax retention credit, because the second draw and using those funds for payroll costs could impact that credit amount.
So
Eidl funds, go ahead, Alan.
So the amount budgeted for this new act is almost as much as the amount budgeted for the original CARES Act. So they certainly expect a lot of PPP borrowers to get a second bite and to get a lot of employee tax retention credits for wages. So make sure you get your share. And while the deadline for the second loan is March 31st, 2021, I would apply as soon as you have the application in hand and are sure that the application will not hurt your employee tax retention credit situation. As far as getting this second loan, because what we found was people who applied early in the CARES Act process had all the advantages of anything that the SBA had not yet ruled against. And everyone who filed later was subject to whatever SBA rules had come out. Most of what the SBA comes out with is anti-borrower, not as a bad thing, but just because Congress leaves such large gaping holes in the information that they provide. So we think that sooner rather than later, yes, it's great to try to understand every detail, but it's also great to be first in line to get your money. You can always apply for more later, usually, if the SBA comes up with rules that would help you. But you can't apply later to get things where the SBA has issued rules that can hurt you. So I do think that time is of the essence here. Now, the EIDL loan program, everyone knows that's the 1,000 per employee up to 10,000 total. We don't know how that $20 billion is going to be distributed, but $20 billion isn't much considering that PPP got another $300 billion. So this is probably almost all going to low-income community banks or businesses or people in certain zip code addresses. We don't know yet. Another thing we don't know a lot about, it's going to be interesting to watch, is that entertainment venues that have been shut down because of COVID-19, including theaters, are getting a lot of money. $15 billion is a lot when you divide that by the number of theaters that there are in the United States. They're able to get 40% of their 2019 gross revenue. Now, a lot of theaters run on very, very small margins, typically maybe paying 90 to 95% of the ticket cost to the talent and for the operating expenses that they don't have. So this will be a big windfall for these organizations, but they can only spend the money on going forward expenses and normal amortized loans, not on what they borrowed to get through the crisis. So that is kind of a messy situation. The EIDL loans charge 3.75%, and if you read the small print, it's not pretty. You can't pay bonuses to your employees. You can't pay distributions to your owners without written consent from the SBA. If you go to try to bankrupt that EIDL loan out, the SBA has special rights as a creditor under state law. So be very careful on those EIDL loans. And if you take an EIDL loan, then it's less necessary that you would need a second bite PPP loan. So do tread very carefully out there in these areas. Brandon?
Yep. So number 10, we mentioned briefly earlier, but you can now amend your initial loan application if you have not yet received your forgiveness amount confirmed by the SBA. In a couple of situations where that makes sense to maybe look at whether it applies or not. If you're a seasonal employer, there were some alternative calculations that came out May 19th that might help you get a larger loan amount. So take a look at those. If you're a partnership and you didn't include partner compensation in the partnership application, then you can amend and request a loan amount for partner compensation. You can also amend to include those group insurance policies that we mentioned earlier, the life, dental, vision, disability. Those can all be added in as eligible payroll cost, and particularly for restaurants as well. May 22nd, rules were issued that allowed for tips paid by customers to be counted as a payroll cost. So if you didn't include those on the initial application, you can go back, amend, and request additional loan amounts for those items as well.
So I suggest we go to page 38 and just talk about this employee retention credit. We have a lot of laymen on this talk, and we apologize that we're talking like lawyers for lawyers and CPAs. There are good articles out, especially I've seen some on Forbes that talk about these rules. Brandon and I have also been giving sponsored webinars. If you're interested in seeing one of the sponsored webinars, they're not free, but the sponsoring organizations are sometimes not for profits. Just send us an email that says the word sponsoring, and we'll send you information on the longer webinars if it's of interest. But I think the big sleeper here, and the thing that's going to take the most calculation and is going to possibly pay out the most money is this employee retention credit. So Brandon, if you could take 5 or 8 minutes on this, as you do so well, being very clear on what people can do for 2020 and what people can do for 2021, and then I think we'll wrap this up.
Okay. So the employee tax retention credit was included as part of the original CARES Act, but the catch was if you got a PPP loan, you weren't eligible for the credit. Well, now the new act says you're still eligible for the credit regardless of whether you got a PPP loan. The catch being you can't count the same wages twice. So if we use the PPP funds to pay the wages, we can't also use them to claim the credit. But how exactly does the credit work? Well, you get a credit on your payroll taxes for up to 50% of the wages you pay to your employees through March 12th, 2020 through December 31st, 2020. Now there's different rules for 2021. So this just applies for 2020. The new act didn't change anything as far as computation of the credit for 2020. To be eligible, you can meet one or two requirements. Number one, you either had your business shut down due to orders from the government due to the coronavirus. You're only eligible for the credit during that time you were shut down. So generally, you want to look at number two and see if you're eligible for it first, rather than just relying on number one. Because number two, if you had a 50% drop in your gross receipts, then that entire quarter is eligible for this credit. So we're looking at 2020, the quarter compared to the same quarter in 2019. If it was a 50% drop in our revenue, then that is an eligible quarter, and all wages paid during that quarter are eligible for the credit up until the time where we reach a quarter where we're back to 80% of the gross receipts for that same quarter in the previous year. Now, you are limited to just $10,000 per employee for a max credit of $5,000 per employee across the entire 2020 year, and you can't increase your wages to maximize this credit. You have to keep paying the employees the same amount or claiming the credit against the same amount that you were previously paying those employees. So now for 2021, the rules change and get much better for businesses. So the 50% goes up to 70%, and it applies for wages paid through June 30th of 2021. We still have the same two requirements, except the gross receipts test goes to 80% of the gross receipts for the same quarter in 2019. So we look at the quarter in 2021, Q1 2021 compared to Q1 of 2019, Q2 of 2021 compared to Q2 of 2019. If we had a 20% drop in receipts, then we qualify. If you qualify in one quarter, then you can use, or if you're looking at this test, you can always use the prior quarter to also qualify. So in Q1 2021, we could look at Q4 2020 compared to Q4 of 2019, or in quarter 2 of 2021, we could look back at quarter 1 of 21 compared to quarter 1 of 2019. Little complication there, but we have some slides that go through the examples of how they work and whether or not you're eligible, and we'll touch on those in just a second. So the limitation also applies differently. It's $10,000 per employee per quarter, not the entire year. So we can count up to $20,000 of wages per each employee. You get 70% of that as a credit. So that's a $14,000 maximum credit for 2021 through June 30th, unless they extend it for an additional period of time. There's also no limitation on the amount that you were paying them, so you could increase employees' wages to qualify for this credit. Again, we mentioned that you can only claim it not paid with PPP funds. Your healthcare costs are going to be included as a qualified wage, so you can add those in and claim the credit on those healthcare costs. That also implies even if you aren't paying any compensation to that employee. So if you furloughed the employee and you still are paying their healthcare, that healthcare counts as a qualified wage eligible for this credit. You can also request an advance of the credit, which is a nice way to get a lot of cash here at the beginning of 2021. If we qualify, you get up to 70% of the average quarterly wages you paid in 2019, still subject to those caps, but you can get a large cash payment here at the beginning of 2021, and then you have to reconcile this on your payroll tax returns in 2021 to even out the credit, whether it's less or whether it's more. You have to reconcile. One catch is for the 2020 tax year, if you had more than 100 employees, you only get the credit if those employees were staying at home and not providing any services. So that applies if they're telecommuting, that's providing services, so you're not eligible for the credit. If you have less than 100 employees, doesn't matter what your employees were doing. They could be working full-time in the office every day. They could be working from home. They could be not working at all. If you were paying the wages, you get the credit. For 2021, that $100 or 100 employee limitation goes up to 500. So a lot more businesses are going to be eligible to claim this credit in 2021 versus 2020. Couple of quick examples. I know we're running low on time, but just to show how the gross receipts test work. And we're looking at 2019 compared to 2020. So in this quarter two, we had a 33% of the gross receipts that we had in 2019. So that qualifies. Q3 also qualifies. Q4, we're above the 80, but we still qualify through the end of that quarter. So those are all eligible quarters. Here, another example, we're back up to 80% in Q3, so Q4 is no longer an eligible quarter. 2021, you can see how this works, less than 80%, so that's an eligible quarter. And Q2 is also an eligible quarter because we can look at the prior quarter and use it as well. Maximum wage calculations are here, 10,000 per employee limitation in 2021, and then 10,000 per quarter in 2020, or sorry, in 2021. So we can count all the wages paid in these examples subject to that 10,000 per quarter limitation. So you can see large credits potentially available on payroll taxes. And again, I would recommend checking out Tony Nitty's Forbes blog on this. Great examples, great analysis of the law, great analysis of how you can coordinate this with the PPP funds and how to maximize the credit. So I think that's where you go for more resource on that.
So I think CPAs are going to be very busy telling their clients what their gross receipts were for January through March 31st, 2019. And then business people are going to look at how they can reduce their gross receipts for the first quarter of 2021. It's the same type of income tax planning we've been doing for years to reduce income from one year and push it to another year. Now, a lot of people are going to be looking at pushing revenue from that first quarter 2021 to the second quarter 2021 in order to get this retention credit. So that vacation you've been thinking of taking to a remote cabin somewhere, sending your key employees to a retreat, maybe missing billing in March, those types of things, I don't think they're going to be prevented under the statute. I don't think that they're immoral or unethical. People have been doing this in the tax planning world for decades, if not over a century. So this is going to be something that's going to be very, very important to consider. We get a lot of questions. I know we've fielded probably 100,000 questions since all this started. And probably 15 to 20% of the questions should be answered with, please hire a CPA to explain this to you. Go ahead, there's a lot of money here on the table. I know that money is short, but it's important to get good financial advice, tax advice. By the way, that we do have confirmation. The forgiveness of the PPP loan is not taxable. The expenses that you paid with the PPP loan are deductible. The only question is whether you're going to have enough basis in your S corporation or enough at-risk assets in your partnership to allow you to deduct those expenses this year. You've got till midnight tonight to loan money or contribute money to your S corporation or your partnership to make sure that you have plenty of basis to allow those expenses to come through. Brandon and I think that most likely you don't need to add money to your S corporation or loan money to your S corporation. You probably get basis from the actual loan itself and the fact that it is expected to be forgiven. CPAs who are watching know what I'm talking about. The rest of you, I apologize for speaking in Latin and Greek at the same time. So Brandon and I are going to be working through the weekend, or at least one of us will be, looking at these rules, trying to better understand them, honing in on them, reading to see what other commentators have said. As soon as the SBA comes out with their guidance, we will jump on that with our law clerks and rewrite our materials. We welcome your questions, comments, and suggestions. Have a wonderful, wonderful new year with the one and the ones you love. Please stay safe, and thanks again for all of your interest in these programs.